Welcome back to part 2 of this double episode looking at macroeconomics. And in the previous video, I was talking about data that can be found on the US economic calendar, such as job reports, the CPI, and Fed announcements that can all be used as catalysts for market volatility in order for us to find opportunities to make some money. So if you haven't watched part 1, what are you doing here? Go back and watch it, and then join me in this final part where I'll be continuing straight on with the 10-year Treasury Yield. So we were talking about how the consumer price index tells us how fast inflation is occurring. And what else can tell us about inflation? Well, the bond markets. If you buy a government bond or a treasury note, you are essentially giving the government a loan, which earns you interest each month. And these loans can last for a number of years until they expire. And then you get all your money back. The yield is the annual income you receive from a treasury note, and specifically, the yield on the 10-year treasury note is closely watched by investors and traders, as it is used to gauge how much confidence there is in the general economy. When there is fear, investors will buy treasury notes and bonds, which drives up the price, which in turn sends the yields down. When there is optimism in the economy, the reverse happens and bonds are sold, which sends the yields up. And when the yield spikes up, it's a sign that inflation could also spike and therefore interest rates as well. Another way to look at it is when the yields rise, it means the Feds are tightening monetary policy, i.e. raising interest rates. Right now, the yield is at a 2-year high, hovering around 2%, as the central bank is now expected to be raising rates sharply, as well as reducing the size of its balance sheet, which basically means they'll just be injecting less money into the market, pushing bond prices down and raising yields. So keeping an eye on this can be a very valuable tool as it gives you an accurate reading of market sentiment. Take, for example, leading up to the Great Depression in the US in the 1930s, the bond market was showing red flags long before the stock market showed any signs of trouble. Therefore, Wall Street looks to the bond market to understand what is going on in the economy. Now in my watch list, I keep the 10-year Treasury Yield graph right next to the Dow and the Nasdaq, and you can see that as the CPI data came out yesterday, showing an increase in inflation to 7.5%, the 10-year Treasury Yield ticked up past the key level of 2%, hitting its highest level since December 2019, a signal to investors of the possibility of a 50 basis point interest rate hike. This will consequently contribute to a drop in share prices of many tech and growth stocks whose valuations rely on future profits that are diminished more and more as the 10-year Treasury Yield rises, i.e. the threat of future interest rate hikes. And so the high valuation of some of these tech stocks just can't be justified along with rising rates. So when these companies miss expectations on their earning reports, they get absolutely slaughtered, just as we saw the other week with Meta, Facebook's parent company, who fell over 26% in the day and lost $25 billion. And PayPal also dropped nearly 25% in a single day after announcing a poor outlook. Now, you're probably wondering how all this helps us as day traders in the futures markets. Well, you can use the economic calendar to find out when to look at jobs reports, the CPI and Fed announcements, as they all act as catalysts for market volatility. And you can trade that volatility by having a good understanding of the current market sentiment, i.e. whether it's bullish or bearish. Furthermore, by taking the current inflation crisis and looking at the 10-year Treasury Yield to understand the market sentiment around that, you can be more confident in the positions that you take. And when, say, the Nasdaq takes a nosedive, you can understand why it has done so and make a confident decision to trade it. It all takes a lot of getting used to and can seem overwhelming at first. But if you're keen to learn, then right now is the best time to get involved and bolster your understanding by getting into the regular habit of reading news articles. I use the Apple Stocks app and I read articles on there every day before the market opens and before going to bed. It's really valuable to keep yourself up to date with what's going on in the markets and the economy. Add the indices and the stocks of your choice to your watch list and check out the related news articles. And keep your eye on the charts as well. If you don't use Apple, then the CNBC app is just as good and both are completely free to use. Now, since the beginning of the pandemic in 2020, the markets have been on an extraordinary rally, with the Nasdaq and the S&P doubling in size. But since the beginning of 2022, we've had some of the most insane volatility the markets have ever seen. The S&P was down 10%, the Dow 7% and the Nasdaq 15%. But then they all suddenly rebounded to recover some of those losses in a violent upward swing at the end of January. It's pretty momentous to see the Nasdaq drop nearly 4% in one day after Meta's disastrous earnings report, yet still finish higher at the end of the week. And you can understand why all this is happening if you simply keep an eye on the things that are going on in the economic calendar and the news. The markets are in a panic and no one really knows where we're headed. And could this be the start of a big bubble burst? Many pandemic-related stocks are starting to collapse. Cheap borrowing and easy monetary policy from the Fed is coming to an end. The looming rise in interest rates and the uncertainty of a possible outbreak of war in Ukraine all injects fear and speculation into the market. But really that's all it is, it's just speculation. If interest rates go up this year by the 1% that is expected, that is still an incredibly low amount. And if employment continues to be strong and fingers crossed war doesn't break out, then who knows, this might all just be a slight blip on the radar. Nobody knows, but it's well worth having an understanding of it all if you're trading the markets every day, as it's your responsibility to protect your capital. And you can only do that if you have an understanding of where your capital is going. Now I'm pretty sure we're going to continue to see some crazy volatility over the next few weeks, leading up to the next Fed meeting on the 15th of March, as that is when they will be announcing the plans for the interest rate hikes. So I will be watching that conference very closely and trading as they speak. Now if you feel like you're never going to understand any of this, please believe me, I never thought in a million years I would understand a word of it. And here I am with my own bloody YouTube channel talking about it. It's really not actually that complicated. It just takes some getting used to. So stick with it and it will all start to make sense. Now then, hit me up with a like and a subscribe if you haven't already done so. Check out the economic calendar, see how these things affect the market, and try and start to get used to identifying market sentiment based on the data. Now, good luck, thanks for watching, and I'll see you next time right here on Math Market.